having traveled extensively and being one would consider to be a digital nomad, and now going deeper into this crypto decentralized finance side, how has your travel and digital nomadicness actually influenced how you perceive decentralized finance?
There's you ever heard of flag theory?
Mm-mm.
Flag theory is the idea of diversification, not just with your assets, but with your jurisdictions and nationalities and everything. So the idea is like different flags, diversifying your risk across many different verticals of your life. So, I mean, as I'm talking about this, you can see how this has impacted me, right? Like having multiple nationalities or passports, having assets in other jurisdictions, so not just denominating in US dollars, not just banking with US banks. And it feels a little like tinfoil hatty, especially for us in the US. But crypto and Bitcoin as this like non-sovereign store of value fits into that quite well, because it's not dollars, it's not euros, it's not yen, it's this other non-sovereign currency that kind of fits into that. So I'd say like I was an expat for 10 years and a digital nomad for 3 of those years. So lived extensively outside of the US. The world's a big place, 8 billion people. A lot of people don't think about that. You know, you're working for your US company, earning US dollars with your US real estate representing 70% of your net worth, and everything's fine and dandy until potentially it's not. So it's a bit of a backup plan. Yeah, maybe it's a little tinfoil hatty, but you don't have to go like the whole spectrum. So I think that's like impacted me a little bit, and that kind of parallels into crypto and like the concept of decentralization. There's no central authority that's approving everything. It's a little bit more permissionless, a little bit more free. I'd say that like those values kind of carry over.
What came first for you? Did you always want to get involved in DeFi, or was travel something that led you to thinking there's a better way to bank than the way that we've been told we should?
Yeah, travel came first. I mean, my first like extended backpacking trip was my sophomore year of college. Went for the summer in Central America, and you know, you meet these people. You read books like Vagabonding and like discover the FIRE movement, things like that, and you find out like there's a world outside of like graduating, getting a job, working for 40 years, and retiring.
Is flag theory, so there's a diversification piece within the United States that people want you to do and segment within different markets, but that's still within one economy.
Totally.
So does flag theory then have to do with you diversifying outside of that specific economy?
Exactly.
Because it's something like, whatever it was, it's like 95% of people say they're diversified, but they're only wherever they live. So if you're a Swede, all of your money's in Sweden.
Correct.
If you're an American, all of your money's in the U.S.
Correct. And it's even worse. I mean, the U.S. has a hegemony in the U.S. in the globe and is a superpower. So it's less of a worry until it is, and maybe it's never a worry. But if you're earning U.S. dollars, you own property in California, which is a significant portion of your net worth. You're employed by a U.S. company. Your other assets are in the U.S. stock market. You're pretty exposed to the U.S. market and don't have like, you know, the rest of the global exposure. Not saying the rest of the globe is, every country has its own issues, and a lot of them a lot more issues than the U.S.
Do you think there's a benefit to being in the U.S. as opposed to elsewhere?
Totally. Yeah, I mean, I think globally, like, you go for a walk down a street in any emerging market in Asia, and like the crane is the national bird. Like there's cranes everywhere. There's construction. There's like progress. There's they're catching up to the rest of the world. Then you do the same in Europe. Pretty ossified. You know, the roads are narrow. They were built long before like roads, and it's like less change, more conservative. And then I'd say the U.S. is like, the U.S. is a big place, so it kind of depends where you are, but somewhere in between that. So no, I mean, I think the opportunities in the U.S. are pretty unparalleled, I'd say. But now with remote work, with geopolitical things in the U.S. right now, like there's some other very good hubs globally. I think if you were young and ambitious and looking to do a certain industry, a certain vertical, might make more sense.
Interesting fact: the roads were the width because of horse-drawn carriages.
Totally.
Which is how wide they needed to be, and now some of these roads are too small for cars to actually
you try driving a U.S.-sized truck down those things. It's no bueno, right?
So under the umbrella of decentralized finance, what would a benefit be for someone living in the United States because the goal is to decentralize it?
Yeah. Well, so I'd say decentralized finance, DeFi, is like a subsect within cryptocurrency overall. So for most US people, there's not much benefit. Like, I don't know, you have access to credit from your bank. You have a credit card with a $50K limit. You can spend whatever you want for the month. It works everywhere. You have a paycheck and a bank account, and you have you can get a loan to buy a car. Like, everything kind of works. So I'd say for the vast majority of Americans, like, DeFi isn't that groundbreaking because we have decent financial infrastructure that makes our life like work reasonably well. The difference is, like, I mean, crypto is permissionless, which is a great word. Like, you don't need any permission for me to send you money. I don't need any permission to move this asset and take a loan against it. I don't need, these are the big ones. And, in a world which you are permissioned to do these things, it's not a big deal until you're blocked. Like, I don't know if you've ever needed to transfer money over a certain limit, and you have to go into the bank and you have to verify your identity 35 different times, and it still takes 5 days to clear. All that shit with a blockchain is instant. It's censorship resistant. It's permissionless. It's instant finality. So I send it to you. You have it within a few minutes, and it's in your custody. So there's also downsides. If you lose your password at a bank, you can walk in there and you can verify your identity and you can recover it because they're custodying your assets. But if you're self-custodying these assets, then the risk is a lot higher. If you lose your password, there's nobody to recover it. So it's on you. So that's where, like, for most Americans, no, man, life works pretty darn well. But keeping in mind that everything's permissioned, that everything has a little bit of a lag, that there is some central authority in between multiple ways. There's fees, there's checkpoints, there's permissions along the way that most of the time they work well for you and they help you until they don't.
So in a way, it's similar to the vast majority of Americans benefit from dollar cost averaging into an index and having it at a brokerage and just
totally
set it and forget it, and every month it pulls money out. Or there's someone who could then go the self-directed route through a custodian and then do the things themselves, but they're the person that's then on the hook, and it's no way insured by a brokerage because they're the one directing it to. I'm writing a promissory note to this person, and then I could never see it again.
Totally, and it's in the U.S. you think about, like, defined benefit plans, like pensions. A big company used to take care of you into retirement. Now it's defined contribution plans, a 401k. It's more on you as the individual. Like, some things are, like, coming back to the individual, that you're the captain of your own ship. Like, we're not going to take care of you. So yeah, it could be some parallels there.
Since travel came first, what was the tipping point for you specifically that led to you wanting to get more interested in cryptocurrency and decentralized finance and shift towards this more permissionless state?
Yeah. For me, I mean, the first time I heard about Bitcoin and crypto, I was working at JP Morgan, the big bank, and it was from my sister, so kudos, Jess. And and she sent me some article, and I mean, this was probably like in one of the first hype cycles, like 2013, 2014.
She had no idea what that seed was going to plant.
Well, no, I mean, it didn't plant anything. I was like, whatever, it's some weird drug, internet money. I like many
just
people
took a decade to germinate.
Yeah, exactly. Didn't precisely. Didn't look into it that much. Told her just to buy the S&P 500 and like focus on your other skill sets, then in 2016, 2017, had a friend that was a developer in Thailand when I was living there who said, this thing Ethereum super awesome. I bought some, it keeps going up. So like any good speculator with disposable income, I'm like, okay, well, buy me some and then we'll talk about it next week or something. And it had gone up significantly like in that week. So we started digging into it a little bit more. And so speculation and interest was probably what got me into it initially. But then 7-8 years later, I'm still very much interested.
What does your mental model look like for making decisions like that and speculating, having come from a very structured financial background?
Yeah, I think that was at a time I was working in private equity. I wanted to do more speculative investing. So I'd say I probably skew more conservative from like an investment perspective, but had always known, been an asset allocator and known that there should be a small portion that's sub 5% of your portfolio that's just kind of YOLO bets. And if they 100x, cool, you can buy another vacation home. And if they don't, it's 5% of your portfolio, better luck next time. So I think that was at the point that I was starting to think that I should have more of that higher risk allocation. It was around that same time, me and the same buddy, we started a young venture capitalist group. So we decided early stage startup investing was where we wanted to put some assets. So we started meeting with startups and trying to allocate capital as young VCs. And this was 2015, 2016, before everybody was kind of talking about it on the internet. There weren't good crowdfunding sites or anything at that point. But
and this was just you two pooling?
Me and him and another guy, yeah.
And how did you select the investments that you guys were going to do?
Well, poorly. I mean, it's I think this is the thing when people decide they want to angel invest. And I have some friends here in LA that hey, I made this great angel investment. And they give me a 45-minute monologue on why it's the best company ever. And you're like, okay, well, how much did you allocate? Okay, well, how much is that in relation to how much you're going to allocate to angel investing? And normally it's what? No, this is the one. And you're yeah, maybe it is, but you should probably take a big chunk, split it into 20 of these things. And that 19 of them are probably going to go to zero, even though the founder and the business plan and their go-to-market and they're just perfect founder market fit. They're just going to crush it and spend so much time. Yeah, maybe they will, but statistically, startups are really, really hard. Early stage startups are very, very hard. But there's always a chance and you're getting in early. So spread it out over, 10 to 20 to 30 of these things would be a better choice.
Trying to find more of an asymmetrical approach to if one goes to the moon and 19 hit zero, you still are ahead.
The math still works, right?
Yeah.
And I guess it depends. If your goal with the angel investing is to get closer to the business and the operations, and you're helping this friend from more of an advisory capacity because you have this stable 9-to-5 and you want to experience what it is to be an entrepreneur, then you can make the case for allocating less. But if it's strictly for returns, having that portion of your portfolio into angel investing and early stage, like need to do a couple.
So what does your present allocation look like with both crypto as well as more traditional investments? And has that shifted percentage-wise? And has that shifted since you left a more traditional background?
Yes. It's skewed, I'd say. I mean, I did like over 100 angel investments. I'm an LP in multiple VCs in my own fund. So pretty skewed heavily into the early stage, higher growth, startup, crypto, higher risk area. But it's something I think about. It's something I chart out. It's something I think about diversifying into less risky things, let's say.
And even though that's the most challenging place to be, that's where you want to spend most of your time.
Yeah, man, it's awesome.
So how, put it through your lens, the average person who's interested in getting involved in more of this decentralized approach, wanting to potentially do some angel investments, how would you recommend they spread out their capital?
I'd say first, read some books on it, watch some videos, like come up with a number that you're comfortable allocating and comfortable losing
as a whole.
So, I mean, a lot of people, I don't know, maybe people do now with softwares and stuff, but like, you know, well, you're different, but with like, take a random group of 10 of our friends. How many of them can say like what percentage allocation to each big asset class? Like not many. So I think first would be like, do that, find out what your current allocation is, find out what you are willing to allocate to angel investing, do your work, study. I mean, there's some basic books. I know Jason Kalkinis is like his own sort of animal, but his book Angel is actually quite good for like an intro into what this looks like, how the math works. So that would be the first thing. And then when you're actually ready, how much you're going to determine, how much you're going to allocate into a number of deals. I'd say spend 6 months or a year just looking at deals and saying no. So, I mean, I think back to me as an angel, which was always kind of a side thing. I'd see a good amount of deals, but, you know, it was always like, you know, flipping through the decks on the weekend and asking the founders a couple questions. But now doing that professionally, like one, the like top of funnel, the number of deals we look at, and then the amount of due diligence or research you do on those deals and finding other competitors that maybe you haven't talked to. I mean, there's, you can always do more due diligence with early stage stuff, but I'd say it's very important not to write checks right away and to start seeing more of these deals. So you start to see like,
build patterns and see things as they come through.
Well, and it's like,
and you also find then your own risk tolerance and what looks good to you and what doesn't look good to you.
And what's a good deal and what's a good founder and what's a good pitch and what's a good go-to-market and what's a good answer to the questions that you're asking. I mean, all of these things, you can't expect to be good at something just walking off the street. And it's a very different animal. And when being an investor, it's very clear what I want out of the conversation. You're a founder, I'm an investor. What do I want? I want to give you money. I want it to 100x in a short period of time, and that's great. So if you're a crafty entrepreneur, which most are, my needs are known. My wants are known. All you have to do is craft your message, craft your comments, craft your answers to like craft that narrative around what I want, and I'm gonna be happy, you know. So knowing that you're kind of being psyoped by whoever you're talking to and to telling you exactly what you want is also super important.
Do you have a set criteria for top of funnel that you pass things through, or a filter you pass things through in order to see if it will get to the next step?
Kind of. it has evolved. So I like checklists. I like processes, as clearly you do, but
no,
just never. It's all shoot from the cuff, always. No, but like I think with startup investing, it's hard to checkbox all of these things. So there's some, but yeah, the unsexy answer is it's probably vibes a bit. Ultimately, it's a people business. You're investing in the founder. If it's early stage, they're probably going to pivot. So their first idea isn't their final idea. So it's backing a person, a mindset, like what they're trying to do, versus the actual iteration of the project. I do strongly prefer not first-time founders. I'd say that's a big one. I mean, I've been a founder multiple times. You make idiotic mistakes. It's part of it. It's like cutting your teeth, you know? Maybe if they have like a great, like strong COO or business advisor or somebody that is more experienced that's able to like steer them away from some of these traps. But that's a big one.
So, when you say first-time founder, do you mean someone who's successfully started and exited something in the past?
No, I mean like this is their
first time
and
starting
their big
anything.
one. Yeah, they worked at McKinsey or BCG and like, you know, they're
Stepped
super
out to
smart
go on their own.
consultant. Like now they know that this is a good business opportunity and this is exactly how they'll do it. And they know exactly what to do. It's like, yeah, that sounds good and that makes sense and you're smart and you put together a great pitch deck. But like, I would almost rather have that guy that dropped out when he was 16 because he was like doing some e-commerce site that he sold, that now he's found this knowing thing that is driving him crazy. He's got this chip on his shoulder because he's from Ohio and he never had all of these things. I'm from Indiana, so you know, it's close enough. Yeah, I'd much rather.
I thought you were talking about the other Ben.
Yeah, is he from Ohio?
No, Midwest though.
Yeah.
What would be from the investor perspective, the seat that you sit in? What would be your 2 cents or advice for a founder coming to you looking to get a check?
Well, we only do crypto, so operate in crypto is the first one.
Filtered check number 1.
Exactly. I'd say I used to give this talk that I need to resurface and do again. And it was, I forget what it was called, but like how to raise capital in Web3 or crypto. And one of the first slides was, just because you can raise capital doesn't mean you should raise capital. But I think that is like the most important thing for a founder that would be thinking about pitching me is like, okay, you think you want to pitch me, you've got this deck, you know how much you want to raise, you've got the plan, good. Now, close your computer, go for a walk with your founder, your co-founder, or the rest of your team, and sit down and like, do you realize what bringing on venture capital and outside investors means? It means that now you and I started this company, we're working on this thing and it's great. If we want to pivot, do whatever, we can. If we want to close it down, we can. If we want to sell it at a loss because we want to do something else, we can. It's super easy. You and I are the only stakeholders in this business. As soon as you bring on investors, you have other people in the car that you have to worry about that have a vested interest, that that have a certain expectation of where they want this thing to go and how they want it to look. So if you start off as this venture fundable opportunity, which means, you know, I want to see you work really hard, burn the candle at both ends, or fail trying. But what I don't want to see you do is like just kind of plateau out where maybe, you know, if it were just us and we didn't have stakeholders, it's like, hey, that's a great lifestyle business. You know, it's kicking off $50K a month revenue. We're feeling fine. Our expenses are low. Like, it's a great business. From a venture perspective, no, man, you want that thing parabolic. You want to raise another round. You want to exit as an M&A or IPO with some crazy, 50 plus X multiple. So from like my perspective, from a venture perspective, it's not the best outcome for me. So I'd say like before pitching, it's really make sure that you know what you're signing yourself up for, that you want to build the business that is capable of bringing on venture capital, that is able to produce returns that venture capital wants to return. Those would be the biggest ones.
So that's more of an internal question for a founder then, saying what is the end goal of this business that I want to achieve? Is it that I want to just create a nice lifestyle for myself, or is it that I actually enjoy the game of business to the degree to which that I want to then grow this thing, sell it, and potentially go into another?
Exactly. And I mean, it's tough to know upfront, but I think what you want to make sure is like most people can raise venture capital. There's an abundance of capital and a shortage of smart, dedicated entrepreneurs that want to create something of substance. So if you're in that latter category, like you can probably find capital to fund your idea. You just want to make sure that it's a good fit long term. I mean, these are people that can make your life infinitely easier and better and flow better, or the complete opposite, because the expectations are misaligned and they're just pissed off that you're not doing what they thought you were going to do.
Where would someone start to look for capital if it was maybe not they're a first-time founder, but they're now a founder who it's their first time wanting to go raise? Where would you suggest they go look?
Yeah, good question.
Or how do they start that conversation?
Good question. And this is always the tough one is warm intros are always better. So ideally you would just, ask everybody, if there's anybody in your network, if they have connections to VCs, do a friendly pitch, like ask for some intros after that. That's the most ideal way. I'd say additionally, don't be afraid to cold email. Like the power of a well-written cold email is just incredible. We respond to cold emails, like lots of people respond to cold emails. So don't discount those. That's the dirty crap work that like nobody wants to do. Hire a VA, like set up a process if you want. So cold outreach doesn't have to be email, can be LinkedIn, Twitter, whatever. So I'd say start with warm intros. Don't be afraid to do cold. I'd also say, the skews more for me probably, but like meetups, IRL stuff is kind of like my superpower. I tend to have like exponential returns for time spent at these things. It's a bit of needle in a haystack. Most is like, you'll walk away from a networking event or whatever with like one connection that's like maybe a maybe. And some of those have just paid off exponentially for me.
Talk to me about cold email. If you got a cold email from someone looking for a check, what are the things in the email that you would look for, or the things that you would say this is a very well written cold email?
I'd say what not to do. Don't put a link to use a link. Don't put anything I have to download. Any security respecting VC or person will not download whatever you send in an email, like full stop. So send it in DocuSend or HubSpot Spot or Google Drive or whatever, that it's a clickable link and not like a downloadable file. Keep it short and keep it short, concise, clear. What you're asking with a link is like, we read them, don't follow up for the 90th time, maybe a bump or two, but like if you're on your like fifth follow-up email, probably that investor just doesn't reply to people. Or maybe try another medium. Maybe it's his VA going through the inbox or something.
Anything else?
I'd say for It's probably similar to any other cold email. It's like, this is the opener. This is just like, you just want the hook. You don't need to put like your financial projections and all of this stuff. It's like, you just want to test the water and see if they are interested. And then you can always follow up with more. That would be the best.
It's kind of like a quick blurb.
Yeah.
Plus the deck.
Yeah. I mean, for me personally, I like the offering a time in the next couple weeks and a book to your Calendly so they can book a time. That's always, you want to make it as easy as possible for the person. So it's like, I look in the deck, or I look in the email, look in the deck, and I know, who the hell are you? How much you want? What the hell you're doing? And like, what the hell's the timeline, or whatever. These big questions are answered by quickly looking at it.
It's like a couple bullet point thing so that they decreases the friction for them
Totally
to be able to get to the place where you're able to get
exactly
to an intelligible conversation.
Yeah. And same with the deck. I mean, deck creation, you could look up startup weekend 10 slide template, something around those 10 slides. That's all you need. Throw the rest of the shit in the appendix. 10 slides is fine.
That was something that I learned with the Costa deck.
Oh, I think I sent you that.
I think you did.
I need to save that because I Google it every time. I need to, yeah.
And another good tip, I don't know if it was you gave me or someone else gave me for that too, was the goal of the deck is to get them on the phone, not to tell them everything it is about the project.
Totally. Yeah.
So it's like create more intrigue with the deck and then get them on the phone and then they can answer whatever questions that they have.
Totally.
That was a big...
Less is more with text and everything. And because, look, a startup is your baby. You have a lot to say about it. You're dedicating a significant time and energy into making this thing a success. You could talk forever about it, but keep in mind these like short attention span, and like these guys are getting tons and tons of emails, so we keep it short and sweet.
So talk to me about, this is interesting based on the first two kind of topics and pillars that we went down. How do you balance the ideas of DeFi while running a successful venture firm? Taking a quick break from this episode to remind you that your inputs matter. This show was designed and created to help you build a high-performing, healthy, wealthy life. So if you feel that you're getting value from this episode, please go ahead and share it with someone that you feel would get value as well. Now, fun fact, 90% of listeners of this show are not actually subscribed to the podcast. So if you would take a moment and go ahead and tap the subscribe button, it would mean the world to me. Thank you so much for being here. Now back to the show.
First, it was frustrating that we did our first fund last year. We did a traditional venture model, like a Cayman master feeder setup. This is like a structure that was created in the 70s. It's just a traditional 2 and 20. It just seems so traditional and archaic to set up in this way, when now I could set up a smart contract that has a dedicated investment strategy that automatically pulls out the fees and automatically pulls money from you and distributes back to you automatically. And like everything is automated and streamlined through a few lines of code in the most simple, elegant way possible. That's like the future of finance and DeFi and very much a lot of the things that we get excited about. And yet we went with this structure from the 70s that requires me to have a fund admin and an auditor and like a bunch of legal fees to set it up. So, but we're not quite there yet. There are like on-chain DAO, investment DAOs that are still have some kinks to work out before I'm ready to go fully with that structure. So I'd say the ideals, I mean, ideally I'd do this whole thing on chain, like in a using this new financial plumbing and infrastructure that we're creating within crypto, but it's not quite there. Yeah.
And you went with the traditional model, even though you're raising for people who are wanting to progress that space.
Totally.
Because it's just so far removed, or they're not ready to adopt that from a fund perspective yet?
Both.
Talk to me a little bit about this traditional fund model that you went through.
Yeah.
And how, walk me through that as if I was a child. I've never experienced anything with raising before. What is a traditional model? What is a 2 and 20? What does that look like?
Yeah. So when I say like master feeder, that's just the legal entity structure, and probably lose most of the listeners, so I won't go down that rabbit hole. But when people say they have like a master feeder fund, there's like 6 entities. So it's not just like a master and a feeder. There's like the LP and the GP and the IM and the master. Like there's a whole structure.
What's IM?
Investment manager co.
Yes.
So the way that a traditional fund works in the 2 and 20 is, say the fund is $10 million, or say it's $100 million. Every year you charge 2%. That's the 2. So $2 million every year. These are the management fees that you use to pay salaries, to pay your research associates, to do certain sorts of travel, have an office, etc. Then you're investing that into startups. Hopefully, say this goes 5x. What I do is I give you back your 100, and then that subsequent $400, I take 20%. So I take $80 out of that. That's the 20%. So it's a like incentive. It's also called carry. So I send you back 320. I take 80 as my carry or incentive. So I'm charging you $2 million a year, and then $80 million based on a 5x outcome. So that last one's variable, and it's more of like a sales commission. It's based on how well the portfolio as a whole does.
And is there anyone that you've had in the first fund that has wanted to shift that or change that, or that's this is how things are done?
So the short answer is like everything's negotiable with full stop. With our fund, no, everybody's in at the same fees. So you can do like side letters and have different investors at different fee classes if they're doing something different. We were the same across the board, which is nice. It's a bit of a slippery slope if one investor is getting a deal.
Because then they find out that someone else has a side deal.
And you need to disclose it, right? I mean, you'd be pissed if you find out like somebody else is getting a deal and you're not, and I didn't tell you. So it's like, and I'm pretty sure, like, whatever, in the spirit of transparency, you want to say those. I think you have to anyways. Again, we didn't have any. And from the longevity
of the fund too.
Yeah, exactly. It's like play long-term games with long-term people. These investors, you want to make them a lot of money, and you want them to keep giving you more money so you can make them more money over a very long period of time. So yes, there can be fee breaks on either the 2 or the 20, and it's up to the fund manager and the LP, and it's kind of a side letter agreement.
Tell me a little bit about Fund 1. First start with your involvement with Bankless. How did you get started with them? How did you get involved in Bankless Ventures? And where were you coming from to get to this place?
Yeah. So I was a founder before, co-founded a company called Charge Particles, which was taking NFTs and giving them their own smart wallet. It was like a lower level infrastructural piece, tough to make a really self-sustaining business out of. It's still operating. I moved into an advisory capacity when we started the fund.
Did you sell it?
No, it's still operating, still has a team, still developing a lot of really cool stuff. But I joined initially as an advisor, then came on as a co-founder, and then kind of went back as advisor. But trying to do both was very difficult. So Bankless is a podcast media organization in the crypto space. It, in terms of like viewers and stuff, is probably one of the top podcasts, if not the top. Like Vitalik Buterin, the founder of Ethereum, has been on the podcast like 30 times. It like has a name within the ecosystem, which is allows like the why should I bring you guys on as an investor? It like gives a little bit of answer to that it communicate something to the community, to the ecosystem. I had angel invested with those guys. I knew them just from the conference circuit, from these IRL gatherings, and actually had become pretty good friends with them. So it was a hike outside of DevCon in November 2022. Speaking of decentralization and traveling, it's a bit like crypto doesn't have a Silicon Valley, so it's like this kind of like decentralized traveling band of gypsy people in different different cities every 3 to 6 months. But we meet up and we all go to these conferences, and we were on a hike, and I was with David, one of the founders of Bankless, and I was like, you guys get great deal flow. I've seen your angel investing track record with plenty of 100Xs. Like, you have a great track record. I've co-invested with you. I like the way you guys think. When are you launching a fund? And he's like, actually, we've always wanted to. You'd be great. Let's have a call specifically about that.
And this was on a hike.
Yeah, this was on a hike. And
so these IRL meetups really do pay exponentially for you.
For me, I mean, it's literally everything. Any job I've ever had is, previously it was all from the golf course. Like, every job I ever had was from golfing with somebody. Now it's like meetups and stuff. I got to start meeting more people surfing, I guess, so I can start like getting some exponential gains out of that. Yeah, and it's not like I go into those things with that expectation. It's like these looser connections. Proximity is power. Yeah. Optimizing the surface area for luck. All of these things.
Bring it back to Fund 1 in a second, but I want to double click on these IRL meetups. What does your process or protocol or system look like when you go into these? Is it just strictly build a relationship and have conversation, or is there a certain thing you're looking for or trying to suss out?
Good question. No, I think I don't a process. No, seriously. I mean, people ask this a lot. They're like, what are you trying to get out of this conference? And it's like, I don't even know. I mean, I'll set up a lot of meetings with strong founders and other like potential investors. And those are kind of like those are kind of checkpoints along the week, but the rest is kind of free flowy, and like most of my friends in the space are doing interesting things or interesting people, which kind of attract other interesting people. So no particular process. I'd say as of the last couple years, I do host events at these crypto conferences now. I do a run because it's super low cost and I like to run anyways. There were over 200 people at the last one. It has found a bit of product market fit, I think, within these crypto conferences, which is pretty fun. And then I'll also do Spa DAO, where we go sit in the sauna and do cold plunge at the crypto conferences.
I think hosting too gives you an element of significance within the group too, because
Totally.
they're looking to you to. It's almost an unspoken.
Totally.
They look to you as the leader of the group, and then whatever the leader has, that person is now subconsciously, or maybe consciously, but I would say probably subconsciously, in their mind viewed as on a pedestal.
Yeah.
A little bit.
Yeah. And it gives you like that shelling point, that thing, you do it here, right? Like come over and we'll contrast and like grab dinner. It's like a good shelling point to get people in.
Yeah. I mean, the podcast too.
Yeah, totally.
There's a reason to have a deeper conversation rather than just, hey, let's get a coffee. And you're like, what are we trying to do in coffee?
It's my 5th coffee of the day. I feel like I'm going to explode. Guilty.
What does following a conference, what does the follow-up process look like for you?
No specific process, depends on the person. I mean, if it's an investor, send the deck, send some more information. I'd say following up is the most important thing, as opposed to just, meeting once and then going off. I'm fortunate to have a really good memory, I'd say, with faces and names. So, it's repetition, like, these like looser connections. The first time you meet them, the second time you remember their name and you like remember that they have a kid that's going to kindergarten. You ask about that. Like that stuff is really good. I mean, you've seen my tracker specifically for investors, but I also have one for projects and like founders. So if I'm like really on my game, I'll like drop in notes for each of those. Sometimes I forget.
Yeah. Do you have a specific cadence that you follow up with?
No. I mean, follow up after meeting.
Great to meet you. Here's what we're doing.
And then if relevant, I mean, with the cadence of these crypto conferences being like every 3 to 6 months, it's kind of nice that like
you get touch points throughout the year already.
Yeah, exactly. I mean, you won't go 3 years without seeing somebody. It'll probably be 6 months, maybe 9 or whatever. And that's where like having the events is kind of nice. I'll also host coffee events, and it's like, hey, come over to this coffee thing. So you're able to kind of like touch again.
Shifting back to Fund 1, you tell me a little bit about the initial idea with starting Fund 1 and the track record, because I know you guys have an incredible track record presently on Fund 1, potentially moving into Fund 2.
Yeah.
Where start with Fund 1, where did the idea for that come from, or where did you want to jump in at?
Yeah. So the initial thought, I mean, was pretty easy. That like we've all been in the space for a long time. Bankless has a very well-known media representation. We get access to really, really great kind of exclusive deal flow because of that position. So the idea was to, instead of just deploying angel capital, like as a family office, bring on some LPs, so some actual external capital, limited partners, and do the same deals. So we, as an angel, it's a bit of like smaller checks into more companies, less due diligence. So with the fund, the idea was $250K to $1 million into these earlier stage companies. But I'd say at first it was thinking about like, if somebody's coming to us, they're expecting us to write a $25K, $50K angel investment ticket. And you're like, well, actually, I want 10X that. Is that cool? So growing into actually having a fund versus being viewed as angel investors that happen to be writing checks out of a fund was a big learning initially. But the goal with this was deploying to early stage startups, very strong founders. It's a 10-year closed-end fund. So traditional venture, even though the liquidity cycles are a little bit more, lot faster with crypto typically. But venture, in terms of track record, like venture is the thing that you find out in like 3 to 5 years, how well you're actually doing. So you have like glimmers of what could be earlier on, like, we invest in this company at $8 million valuation, and then they raise their next round at 80. But we're like up 10X on paper, but we didn't take any capital off the table. So it's all kind of paper gains. So on paper, our fund looks great right now. I mean, I did the deck like last week, but the investments, we've done like 50 investments, and our portcos have subsequently raised additional capital of like $400 million, which is insane. So that means that like at least some of these investments, like other investors have found them very investable, I guess, and deployed a lot of capital into them. So like on paper, without discounting these things, our fund is up like 3X in a year, which is pretty good. But again, I mean, when we launched, ETH was probably at 1,800 or 2,000. So like, with crypto, it's like, hey, great, that's 300. Like these are 3X returns is significant, but you're always kind of benchmarking versus Bitcoin or ETH if those investors were divesting out of those assets into the fund. So that's kind of like our internal benchmark. So we're beating it. as of now. But it's like, again, very early on into a longer term process here.
And what is the intention with starting a second?
Yeah, so the idea is we'll be 75% deployed out of this fund. So you're kind of on the tail end of deployment, like new capital into new startups. We raised last year in 2023, which I don't know the stats off the top of my head, but in terms of like new capital deployed into venture, it was way down. New capital deployed into crypto venture, like significantly down. Lots of people were not raising. So we were fortunate enough to hit our target. We wanted to raise 20 to 40 million bucks. We raised 40. We've deployed it well into good startups, a portion into liquid. So the idea now is like there might be a little bit more appetite to deploy into funds. We can raise this fund to about the same strategy and process, and then call capital early next year. So run it back process we kind of theorized is working. We're able to get the allocations we want in the companies that we want. So yes, access to deal flow, but actually also winning deals. So we're going to run it back with another one.
Same check size or larger?
Probably larger, skewing larger on average, yes.
Is that the goal? Is there a long-term goal for these funds?
So it depends. I mean, there are funds that, will invest in 50 to 100 projects, and they're very low touch, not a lot of like just kind of write a check. Okay, good luck. Let us know when you 10X, hands-off investors. And then the other side of the spectrum would be like highly concentrated, high ownership, almost quasi-incubated projects. It's like you're the founder I'm investing in. You're sitting down with my external dev team, and I'm supporting you with legal resources. So and we're like on coaching calls every other week because I own 10% of your company, and I like really want that to be a good exit for me. So that's kind of like the spectrum. I'd say our first fund skewed more towards the former. But now we've staffed up. Like we have a portfolio support person, we have an ops person, so we have more time and ability to actually spend more time with these portfolio companies. So somewhere in the middle.
Who would be an ideal company or an ideal founder for you to come to you for the second fund?
Still earlier stage, so pre-Series A. I'd say probably like 70% of our deal flow is either DeFi or infra. So those are kind of our sweet spots. Those would be like the big ones. I mean, the founder and the founding team have to be in it for the right reason. Like crypto does skew towards a bit of like short-termism. Crypto's hard. Like starting a startup is hard. Starting a startup in crypto is extremely hard. Like take whatever amount of friction you have to getting an actual customer and like 10x it. It's just way more friction. There's a lot better infrastructure now that a lot of that is abstracted away, but it's still, it's a hard path. So you want to make sure that this founder is in it for the right reasons.
Shifting gears slightly away from the fund and more towards you as an individual, having this traditional finance background, the CFA background, and then now moving into crypto and DeFi, how do you personally view money?
Yeah. How do I view money? Bitcoin used to be called the mind virus because as soon as you learn about it, you start questioning money, which typically you don't. And I'd say post-COVID and like the trillions of dollars that have been printed, and now with the social media and YouTube and people talking about, fiat debasement is a little bit more prevalent. So I'd say my views were more radical before, and they're probably closer to mainstream now. I mean, Bitcoin and crypto is a hedge against irresponsible fiscal and monetary authority by centralized central banks. It could be, or it could just be some crazy speculative asset. But but I do know that trillions of dollars being spent debases currency. I mean, we feel it, right? Like our costs higher than they were 2 years ago. I went for a salad and a beer and it was $70. Like, that's insane. So I think it just makes you think a little bit more, I'd say outside of just money. It's most of our internet going through a few large companies, most of our AI models going through a few large companies, all of our money being controlled by a few old men in a room. Like, do we want that centralization, or do we want something that skews a little bit less? Bitcoin was about like the separation of money and state. DeFi, I'd say, and Ethereum were like the separation of finance and state. There's like a push for decentralized AI, which is the separation of like AI and these big institutions or the state. So I'd say like what I think about money is kind of like abstracted into that as well.
In relation to finance, what is something that most believe to be true that you disagree with?
Most believe to be true that I disagree with? Depends on the most. I mean, I think a 60-40 portfolio for like boomers is dumb.
60 in
like 60 stocks, 40 bonds. I'd say
pretty antiquated way to view it too, though.
I'd say
not even my dad's.
Yeah.
Oh, at least he's probably 100% in CDs at this rate.
Yeah, 5.5% shit. I mean, it depends. I'd say one here in LA is like renting is not flushing money down the toilet, which you hear a lot. People renting affords you a bit of flexibility, a bit of portability that, if you value that, can be worth more than like flushing it down the toilet. I'd say that's probably one.
Do you think now, this phase in your life, you're leaning more towards continuing the travel trend or putting roots in purchasing a home and staying in one place?
Roots, home. Don't know about purchasing a home. I mean, at least not anytime soon in LA. I mean, maybe it's a great investment, but there's always an opportunity cost. There's always other investments.
Ben, this has been great. What have I not asked that I should as relates to finance?
What's on your mind with finance that I haven't answered?
I think I've asked the majority of the questions.
Yeah, I mean, it depends with your users. I'd say like with crypto in particular, it's easy to, a lot of people think crypto means trading crypto because there's like people online posting charts and little drawing lines on graphs. I would skew, if you're interested in crypto or Bitcoin, skew away from that short-term price movements, volatility, those sorts of things. Go back to the basics of why crypto is significant, like what I was talking about with the organization separation of money and state, these sorts of things. And those are a bit of the like core principles for why this matters. And, you know, the lines on the graphs and your friend saying he made a bunch of money on a meme coin, you know, this is not the whole reason why it's there. There's a good book, Chris Dixon, Read, Write, Own. So Chris Dixon of E17, he's actually an LP in the fund, but his book is meant to be that of like why this matters. So could read that one. Another really good one, would be a YouTube video, and you should link this in the show notes. But Eric Voorhees gave a talk last year at Permissionless titled "Why Are We Here?" that was fantastic. He has a way with words, and it's very he's a bit libertarian, and like it's very good. So watch that video, read that book. There's plenty of other resources. Message me, I've got some. But focus on the big reasons of like why this thing is significant versus the day-to-day like nonsense headliners.
Yeah. I think as a whole, and to kind of summarize everything here today, people get into or want to learn more about investing to make more money. And with your background and expertise, what would you say is the singular input as relates to finance and investing that has provided you the greatest return so far?
I mean, it's investing in yourself, like truly. I know that's like such a cop-out answer, but any of this personal knowledge, people you surround yourself with, these are like the highest leverage for terms of returns.
Ben, thank you.
Thank you.